Oh, here we go. All right, folks. The forge is red hot. Welcome to the Blacksmith Podcast. This is the Saturday morning or Saturday afternoon Discord edition, Saturday at 12 p.m. Pacific Standard Time. Um, you don't have to ask if we're doing it. Just jump on and we're going to be here. So today we have a special treat for you. There's another blacksmith who is in his forge, and he is going to do our options class and teach us the basics about buying options in the stock market. If you've never heard of an option, if you don't know what we're talking about, he is going to break that down. With that being said, you see the T-shirt, you see the arm and hammer. I'm just kidding. That would be a intellectual property strike. This is an arm with a hand holding a hammer, striking an anvil with the TBP. And you know what the back of the shirt looks like? I think you do. Hold on, let me grab one. These are going to be on sale pretty soon, but not yet. I'm trying to figure out some logistics. But without further ado, I think we've held it off long enough. Let's let the other blacksmith come in and do his thing. Over to you, good sir.
$51.
I was going to
And
go
if you're
into
thinking,
it to show what you're talking about. You want me to do that or go to the one I actually have?
well, we'll stick with the screen. It's fine.
Okay.
Shares out of it.
The contract
I'll,
end date. Oh, sorry, I was muted. Okay, so what I can do if you want, I can jump and go to let's go to this hood call. Do you want to talk about I don't know what everything means? I had pulled up like what is an option? We could go over like defining them or whatever.
Yeah, I mean, as far as like what is an option, like I said, you got the two types. You got the call or you got the put. Um, if you buy the call, to try to give like a super basic example, it's almost like putting a down payment on something um, to lock in your price. So if you buy a call for Robinhood markets at $55 and the price jumps all the way to $80, whatever your premium that you paid to buy the option, that's your down payment that locks in your right to buy 100 shares at that $55 price point. So you're
Yes.
not paying $80 a share, you're paying $55 a share for the 100 shares. The only caveat is you have to buy in the groups of 100 shares. You can't just exercise 30 shares and then let the rest go to waste. You got to buy all 100. When you're buying a put, you're buying the premium is basically giving you the right to sell 100 shares. You don't actually have to own the shares. I don't mess around with puts really at all. I don't have as firm an understanding in puts as I do calls. So you know what they say: if you don't know nothing about it, don't mess with it. It's a good way to lose a lot of money. But calls and puts both. I mean, the big thing, you can only lose the premium. You can't lose anything else. If you just straight up buy 100 shares of Robinhood markets and some crazy scandal happens, knock on wood, and they just go to nothing, you lost every dime you put in. If you buy the call for Robinhood markets, you can only lose that premium that you paid to buy the call.
Yeah, so let me see. The chat wants you to go super basic and super slow. I heard what you were saying right there, though. Basically, a put is you betting the stock is going to go down and shorting the stock, as it may be commonly referred to. And a call is betting that the stock is going to go up. I like your down payment example. Let me see. Chat saying they didn't follow too well. They understand the theory, kind of, but can you explain it like to a child? All right, so Einstein did say if you can explain something to simply, you don't understand it yourself. He definitely understands it, folks. He just he we gotta break it down into bite-sized pieces for y'all. He's already at premium. You're lost. Okay, so they're asking like at the basic level, are you buying the shares or the right to buy the shares, or basically let's start from I don't really know. At its most basic level, an option is like going to Vegas and betting on the stock. Would you say?
Pretty much. That's my fault. I didn't have the chat pulled up. I was just watching the stream. Yeah, basically, trading options is a lot like gambling. I mean, theoretically, all investments in the stock market are a little bit like gambling, but options trading is definitely a lot more.
Right. So basically, what he's saying is buying an option and buying actual shares are two different things. If, let's say, Robinhood, the share price is $51.14. Hopefully, my screen is still showing. If you wanted to buy 100 shares, you would have to put up $5,114. But if you bought the an option on it, a bet, and let's say it was a call, a bet that the stock was going to go up to a certain price. Like right here on the screen, $55 from 51, you would only have to pay $2,050 because you're not buying the 100 shares, you're buying the right to 100 shares. And the equity for the shares for the time period that you picked out. And at the end of it, like a lease for a car, you can choose to purchase those shares or you can sell right before the contract ends and somebody else can purchase those shares from you, and you get all the equity that the 100 shares made. Is that simplistic enough?
Yeah, so it looks like a question in the chat here. If price goes to where you want it, you can sell the same right, same contract to someone else. You can. So if you're, we'll say the Robinhood call is for $55 for next January, and we're sitting in August, and Robinhood's already sitting at $80. You can sell the contract you have to someone else and take your profit, and then make that contract someone else's problem. Really, and you don't have to exercise. And the premiums like earnest money, it's like that down payment example I gave. It's like earnest money. You're putting your money down. You think it's going to go up. If it ends up going down, you're just kind of out that down payment. It's like there was one video I was watching on YouTube. A guy was breaking it down, and he used a Taylor Swift concert tickets as an example. The tickets cost $100 now. You put your down payment of $100 down, and now in 3 weeks the ticket prices are $200. Your down payment is already locked in your $100 buy rate, so you don't have to pay $200 in 3 weeks. You can pay today's price in 3 weeks because you locked in with your earnest money. If you're, I mean, if it goes down, you're kind of just out that premium. If it's not at that price point that you predicted it would be, then it wouldn't make sense for you to exercise it because you're going to be paying more than the shares are worth anyway. So you're just kind of out that premium.
Yes, and that I like that. I actually like that analogy of the Taylor Swift concert tickets. That was actually a perfect way to put it. So, look, folks, there's risk involved in everything, and he is exactly right. Even buying uh, stocks or shares of a stock long term is risky. It is risky. But it pound for pound options are riskier because you're saying that with your limited knowledge, which is why, okay, let me say it first. You're saying with your limited knowledge of the company and the CEO and the management and the direction of the company that you are just betting the stock is going to go up or go down by a certain date, or you are out your money. And that is a risk a lot of people should not be taking. And the reason being is because I said this before. Let me say it again. So right here, let's go to, you see my portfolio right here. Let's go to Robinhood itself, right? So Robinhood, when you go to a stock, it shows you who the CEO is. It shows you how many employees they have. It shows you where they're headquartered. Shows you when the company was founded. It shows you all this information right here, right? And then it shows you the market cap. All these things mean something, right? The 52-week low. So stocks, we talk about their 52-week high. Why 52 weeks? Because 52 weeks is a year. So the lowest it was in 52 weeks, the highest it was in 52 weeks. So if you see right here, the 52-week low for Robinhood was $10.51. And if you look now, the 52-week high is $53.90. So it's near its 52-week high. Should you buy it? Heck no. You shouldn't buy it right now because it's near its high. For a rule of thumb for stocks, you want to wait until it pulls back 20 to 30% from its 52-week high. And what we're saying is, if you're going to buy stock, right? If you're going to buy shares, like right now, where is my, I'm trying to find how many, why can't I see how many shares I have? Oh, right there. I'm looking at it on PC, folks. I only look at my portfolio on PC on Saturdays during Discord Live. So I'm sorry. It looks way different on the phone. All the information is up underneath here, but on the PC, it's on the right hand side. So sorry. So look, I have 355 shares, right? It tells you how much it's worth if I were to sell it right now, on average, how much I bought each share for, the return today, the total return, that is the amount of money I've earned, not how much is worth. How much is worth is here, and the total return percentage. But here's the thing: if you're gonna buy even one share, you are part business owner of that company, and that's how you have to look at it. So that means you need to be on Robinhood searching the news down here. If you scroll down, look at the news about Robinhood. Look, they released their quarter 4 earnings report, right? The earnings call come out. You can actually click the link and listen to the chief financial officer, the CEO, the vice president, whoever is on the call doing it. You can listen to them live, and then people have questions that they're going to ask. You can even submit questions before the earnings call, which they do quarterly, right? So for a year, you need to be very, very interested in the direction of the company. Right here, it shows the earnings. This is what they projected, the hazy one, and the solid circle is what they actually hit. So they beat earnings right here, quarter 2, fiscal year 23. Looks like they met earnings quarter 3. They exceeded earnings quarter 4. So all this kind of stuff is what you need to be interested in if you're going to be part business owner of a company. And so options are more riskier. You most certainly need to pay attention to the trajectory of the company. So if you know that you're not going to pay attention, you want to set it and forget it, and you're not really interested in the day-to-day goings on in the market. So some articles are posted. There are articles on companies posted 2, 3, 5, 10 times a day. If you're not going to follow it that closely, then you probably shouldn't trade options. Would you add or take away from that, good sir?
No, everything everything you said was sound about right.
All right, chat. Do you have any more questions for this blacksmith on options? Do you understand it? Do you not understand it? What are you lost on? Do you need more clarification on things? Do you want to see definitions? I can put things up on the screen. We need some feedback, or else we pretty much come to think that you got, or assume that you guys know what we're talking about.
If y'all come up with any more questions within the next week or 2 weeks or at any point in time, you just hit me up in the chat, and I'll do my best to answer. I can get back on here in a month or so and do this thing again. See if anything else sticks that didn't stick this time.
All right.
Hey, Alpha, how much time do you actually have left? This is Ramza, the one who was asking a lot of the questions.
How much time I have left for what?
For explanation.
Oh, I got 20, 30 minutes probably. What's up?
So I haven't done options yet because I figured, why not get a mentor? Why not get someone who understands? I want to go with a low value stock that so I can get some practice on this thing.
Give me an example.
It sounds as though, for example, right now, Ocean Power Technologies, OPTT, the value of the stock has dropped significantly. It went from about $3 down to about 65 cents in the course of half a year or less, probably closer to maybe 3 months.
This one?
If it is one that has options trading available. Ocean Power, OPTT?
I thought that's what I did. Yeah,
What?
OPTT. You sure
Hold
that's the
on
right?
now.
Oh yeah, the
Ocean,
66 cent one, right?
Yes.
Yeah, it was showing like $50. I don't know where that came from.
Yeah, look, I was about to right now.
Okay, so this is the one.
Look,
so
I had 314 shares of that. If that was correct, we just have to make transactions. So, for example, I'm going to go here and yes, you apparently trade options on this.
Yes, you
So,
can.
if I wanted to trade options on this, what is the difference? And I did read their explanation of it, but it didn't make as much sense to me as I wanted it to. There's long call, there's covered call. Can we talk about the calls first? If I understand right, you're predicting the stock will increase in value. Do you have to specify how much?
I mean, buying whichever call you're buying is kind of you specifying how much. Looks like for your Ocean Power, I mean, the longest furthest out you can go is August 15th. They got $1, $1.50, $2, $2.50, $5, and $7.50 call. So I mean, picking whichever
What
one
do
of those
these
calls you
mean?
pick.
What does
It's
what
like
mean?
it's the strike price.
So it's the price to make money, or it has to hit this price in order for you to make profit. What exactly, what are we talking?
So I mean, that's just for you to lock in your like your rate, I guess. So if Ocean Power busts up to $20 by August, and you're holding on to a $1 call, you get to buy 100 shares for $1 a piece.
Yes.
You're that's the I guess the strike price. The higher it goes above the call you pick, the more profit there's going to be in it. If it goes up to a
Oh,
dollar
I see.
fifty, if you have a $1 call and it shoots up to a $1.50, you're still in the green, but it's not as much profit obviously if it shoots up to like $8 to $10. Or so there's two different ways you can buy it. A lot of the calls I buy are already in the money, so I would go into this company and I would buy a 50-cent call, so I'm already in the money, and it gives you a little edge on I guess the outcome. If
Hey,
it goes
real quick,
down,
I'm sorry to cut you. Can you, yes, please elaborate on that? I've heard that on YouTube a lot, and I see right here he asked about a long call, so I picked it, and there is a 50-cent call option. Can you elaborate on that in the money call versus out of the
Yeah,
money?
because it looks like what if I buy it right now, I just execute. Well, yeah, how does that work?
I mean, it was. You're still going to have to see movement in the stock price to make money out of it. You can't just. I mean, I guess theoretically you could buy it and then exercise it immediately and get 100 shares at 50 cents a piece. But you don't. You're going to lose out that premium. So whenever you buy it, it'll give you a break-even price, and that
Mm-hmm.
break-even price is completely contingent on how much the premium was. So, like
When you're
I
saying premium, what does that mean?
how much you're paying for the option.
And right
So
on this one for the 50-cent one, what is that premium?
let me go back to it. Trade options. OPTT for the August 15th 50-cent call. Mine says $40, which is multiplied by
50.
100. So you would
Okay,
be
so we
paying
pay $4 or no, 40.
$40.
Okay, so I pay $40 to hold the right to execute the contract. So it's like loaning it for $40, and then whatever profit you make is after you subtract the $40 that you put in.
Yes.
Yes.
So when you buy
Oh,
it,
got it. Okay.
it'll
Okay.
give you a break-even price, and that break-even price is taking the amount of money you actually paid for that call into account. So your break-even price isn't going to be, you buy a $1 call and it hits $1.01, that's your break even. It's going to be a little higher than that just because it takes into account how much you paid for the premium.
Yeah.
So it
So
is. So
if you look at the screen right here, right, I did a long call option on OPTT and I picked the 50 cent option, right? And let me see. I don't even know. I only picked the 20-day option right here, February 21st. But let me see. Let me see the longest. If I pick August, 195-day option, right? It looks like right here the break even price is 75 cent. So when you add in, because max cost right here is $25. So if you, and that's because each contract costs 25 cent for this 50 cent call. Um, so if, and then, so the max cost has a,
can you hover over the break even?
yeah, right here. I'll highlight it for you.
Gotcha. Gotcha.
So the stock basically from 66 cents only needs to go up to 75 cents for you to break even and not be in the negative anymore for your call. And then anything after 75 cent, you have now earned above the premium. So now it's all profit for you when you go to sell it. But if you were to want to gain all the equity in it and just keep it long term, you could just buy it, buy the 100 shares. Right? Wrong? Good to go?
It's so the break even price is only in regards to if you actually purchase the 100 shares. If you just buy the option and then in 3 days later, it shoots up 30-40% and you just want to take profits and be done with it, you can sell it and make a profit. It doesn't necessarily have to hit the break even price. The break even price is really just for if you're gonna buy the 100 shares, what that would be worth immediately upon purchasing the 100 shares. Because when you buy the 100 shares, you're kind of your premium, the amount you paid for the call, it doesn't just get shuffled into the amount you're gonna pay. You're gonna lose it if you purchase the 100 shares. Does that make sense?
Makes sense to me.
Uh,
Nope, it doesn't make
all right,
sense.
not exactly for me.
Run through it one more time. All right, the 50 cent call that he's got highlighted down here, it costs 40 cents, which is multiplied by 100 because there's 100 shares in a contract. So that would cost him $40 if you were to buy it right now. It says the break even price. Break even price just switched to 90 cents.
Yeah, what happened? I'm sorry, I did that wrong. I didn't have it checked. I didn't click the plus button. So now that I have it checked, now it switched to 40 cents versus the 25. Sorry. There we go.
All right, that's fine. So 40 cents multiplied by 100, you're going to be paying $40 for that option. If the stock price shoots up, we'll say 70 cents or 67 cents now, and it's sitting at 75 cents on Thursday, you can sell your option. You're not going to make a whole lot of money on it. The option will probably go up 10% or so. If you want to pull profits, take your 10% win, then go for it. But if you hold on to it until it kind of matures and you purchase all 100 shares, it's going to have to sit at least 90 cents for you to break even. Because when you buy the 100 shares at the end of the contract, you don't get your $40 back. You're kind of
Gotcha.
taking your
So
win.
it's deductible.
Yeah. So your premium, the only time you don't lose the premium you pay is when you sell it. When you just sell the contract. If the stock goes down, you lose your premium. If the stock goes up and you choose to buy 100 shares, then you lose your premium. But if you purchase the 100 shares, it probably shot up high enough that $40 doesn't even matter.
So if we buy at the lower, say it's a 50 cent call, and it, or 40 cent, like you said, say it goes up to 80 cent just per share. If I sell that contract, I don't have to pay the premium. I just take whatever the difference in and cost is the raw profit?
If you sell the contract,
Yes.
yeah. So whenever you sell the contract, that'll be it'll just be profit. Like if you paid $40 for the contract and you sold it for 200 in a couple months, you have $160 profit there.
Got it. So someone else would they buy that premium? Would their premium be the same if they then bought the contract? They would have to deal with that, someone else's problem?
Yeah, so the premium fluctuates with the stock price. So the premium
Gotcha.
in 3 months could be, we'll say, like, it'll go from 40 cents if you bought it now. Say it's $2 in a couple months, which would be 200 for them. They would be paying the 200 to have that right to buy the 100 shares, and then from there, if the stock price were to go down a little bit, their break even price would be different from your break even price because you bought the contract at two different points in the market.
Got it. It sounds like you're going to do the price that the stock started at, the price that you wound up buying if it reaches maturity and you wind up buying the shares, and then you subtract the premium that you paid, and that's your profit, whether positive or negative.
Yes.
Or I
But
guess if yeah.
yeah, if it's negative, you're not gonna. It wouldn't make sense for you to execute the contract because you could buy 100 shares at 30 cents instead of buying 100 shares at 50 cents.
Right. So you would just be out on your premium.
Yeah, that the most you
Okay.
can lose in options trading is the premium.
Unless you're doing a put,
The
right?
put, the
Can
short and
puts
the stop.
lose infinite money?
I mean, I don't believe so. Every put I've ever bought that went to shit, you only lose the premium.
Okay, but
Gotcha.
here's conversely though, and he can attest to this. There's no maximum that you can earn from a call. It doesn't have a ceiling. However, there is a maximum you can earn from a put
Yes.
because if a stock, you have to think in terms of what's best for business. The house always wins, right? You have a few people who hit the lottery, but remember, it's only because that lottery is heavily taxed, and a lot of that money is going back to the state as revenue for the state, right? So the house always wins. So if a stock is soaring like Nvidia, people had options, calls, long calls, short calls that went up 1,000%, 500%, 200%, not dollars, percent, right? And because some people had their eye on it, they had an options call contract on it 2 years before it started booming like that, right? When it was a fraction of the price the stock was. I think it was at $1,200 when it split, right? And so people saw ridiculous gains in those. However, the business is earning money for the stock market, so there is no ceiling on what you can earn. However, when it's falling, it's losing money. And if it like Hertz in 18 or 19 when they fell off the face of the earth. No, it was 20. I think it was 20. And they fell so far that Robinhood delisted them, right? So the stock market in general, I think, delisted them. So no one could invest in it anymore because they said it was investable, basically. So if you keep putting puts on it, they have to cap you on what you earn because they're losing money on that company. Does that make sense?
Yeah, that one's perfect.
Okay. So if you take this right here on the screen, this is Robinhood. This is a $17 call that was made, looks like last year, right? March 28th of last year. I think this one is two contracts. Yeah, right here. So I have two contracts on it right here. The Robinhood break even price is 25.15, right? obviously the Robinhood is sitting at $51.14 right now. But I got a question because this is something, this is not a test. I actually don't understand this. It says it's a $17 call and it says right here 36.73, but the break even price is 21.15. So if we talk break even price, are we talking the stock price or are we talking about this price right here? What is this? Is this
The
is the
share price.
equity above what the break even is, right?
No. So the break-even price is the share price. So you want
Ah,
Robinhood per share to be sitting at $25.15 to break even. The 36.73 is how much that call is worth. So you said your average cost is $8.15. So you paid $815 per, which is what, $1,630 total investment. And then it's sitting at what, scroll just saying, it's 36.73, you said?
yep.
So 36.73 is how much each one is worth now. So your $1,630 investment is now, there's 36.73 times two, so 73 something. 73 something is how much it's worth now. So that 36.73 is obviously times 100, $3,673 is how much that option is worth now if you were to sell it.
So
That's that market
the
value that
market
we see
value,
right
yeah,
there.
that's what it sounds like you're saying. Yeah.
Yeah. So your market value, yeah. So if you sold both of your options, right now, you would have $7,346 worth of, value there.
So let me ask you, with this option right here, what, because it doesn't expire until next year, a year from now, right? A little less than that. But should I let this go all the way until the end date and purchase 200 shares at, would it be 8.15? No, it'd be $17, right?
Yeah, you would buy, yeah,
Each
100
share
shares
would
times.
be 8.15 or would it be $17? I'm confused.
You're paying $17 per share times 100.
Okay. So if
So
I
$1,700.
go ahead, you got it.
It's $1,700 per contract is how much money you'd have to have if you were to execute them.
So if I don't have the buying power of $3,400, then I can't buy the shares. The contracts just expire and I get nothing.
Yeah, if you let the contract expire and you don't sell it or buy the shares, then you just lost all your money.
Okay, so it would behoove me if I didn't have the buying power close to this expiration date to put them up for just sell them.
Yeah, if your intentions are to sell them, I would decide that early on. Like I said, the closer you get to the expiration date, the less people will pay for it. Um, so if you're gonna sell it, I would sell it probably three months or so in advance is kind of my number for getting rid of them.
So that
I have a
I
question.
actually had planned on selling these contracts when I bought them. And if you think about it, this a 350% return right now. So that means I earned
All right, let me
5,700.
mute.
What happened?
I'll be back. I'll be back in just a minute. I'm gonna mute myself.
Okay, copy. So I would have
Hey,
earned from this decision $5,700 off of two contracts, off of two bets that the stock was going to go up. And they even made it more simplistic because if you say, okay, I think the stock will go to $70. I don't know how to quickly scroll, but you can keep going. I wish I knew how to. You can't drag this and can you drag this? No. Well, if you think the stock is going to go up to like $70, right? It'll simulate your returns on here. So you can do all of this prior to buying it and guessing what you're going to earn. But what was your question? I'll see if I can answer it. But an elephant never forgets.
Indeed. You hear that?
Oh, there's a kid with a question? Go ahead.
No,
Yeah,
that's
go
my
for
daughter.
it. It's never too late. Never too early to learn.
That's right. Get this
Uh,
financial wisdom.
it was related to the price and selling. I'm just trying to remember what. So if you sold it, you would get it. Oh, so right now your your returns are worth. You said 350%.
Mm-hmm.
I know it was related to this. I was trying to figure out the difference. Oh, so when you go to sell this contract, there has to be a buyer. Are the buyers regular people like us or the back end investors? How exactly does that work? Because just because you go to sell it doesn't mean it's immediately going to be purchased, right?
Correct. That's why I was telling him if you are going to sell it, like my number is 2.5 to 3 months prior to expiration. Because the closer you get, the harder it is to find a buyer. Because just because, like you said, just because you post it up for sale doesn't mean somebody's going to buy it.
Would
And
this
yeah,
have
mine is.
anything to do with it?
Is what?
What's up?
The open interest right here, does this have anything to do with it?
Yeah. So the open interest
Oh,
is the like number of orders.
At that same price, right?
Yeah.
Yeah, so this is how you know if people are interested. If that's zero, nobody's interested in buying what you have. So
where are we at?
the highlighted portion, can you see it? Open interest right here with my
Got
cursor.
it. Got it.
Yeah, I don't know why
So
this was.
there are people interested in buying it at what your exact contract specifications are right now. 15,907 open inquiries to purchase what you have the ability to sell.
Yeah, and if you look right here on the left hand side, the bid and the ask, and he I'm sure he will correct me if I'm wrong. If I tried to sell it right now for $38.05, it's red right here, but it's saying 131 people interested, it looks like. But if I try to sell it for 35.40, there's 745 people interested. So it will sell a lot better on the bid price than the ask price.
Hold on
That's.
now. I Go ahead.
I was gonna say yeah, that's right. That's I mean they call it like the spread between
Mm-hmm.
the bid and the ask. Obviously, I mean
Uh-huh.
stock market's just like anything else. So the lower price it is, the more people that want to pay for it.
So I've tried to trade on the off market hours and I see the bid and the ask and they say it's the spread. Does that mean that these contracts only execute during the off hours of trading?
No, I don't. As far as I understand, you can't trade options during the after hours.
That's how I understand it
Gotcha.
too. Yeah. The 24-hour market
Anytime,
is for buying actual shares, not options.
And whole
so
shares at that.
anytime I've gone to trade, and anytime I've gone to trade on the off hours, I pay some type of a premium or additional cost, and they've always explained that it's the spread that I'm the difference between, I guess, the I'm trying to understand it a little bit more. I don't know if it's the difference what they're asking for, plus they add their own tax on. And when you guys were first explaining this, it sounded like it was the same thing as the options, but perhaps not. So I'll do some more digging into that. If you guys have any info on it, more than willing to hear it.
So me personally, I don't think I've ever seen that. I mean, I know the higher price you put, you're willing to pay for it, the more people that are going to be willing to sell it. So if you put, if you were to try to buy a share of Robinhood for $50 even, not many people are going to be selling it for that when it's worth 51.14. But if you put 51.50 as your willing to pay price, there's going to be a few more people out there willing to sell you for that.
Right. It's kind of like a buy it. It's a bet in bulk kind of thing. If you want the right to purchase the shares at a lower price, other people have those shares already at the lower price. And you're going to have to pay them enough for them to be interested in selling them to you, is basically how I grasp it. Is that correct?
Yeah, it's like scalpers of the stock market.
Yeah. Yeah. All right, chat. We got anything new? Anybody got questions on these options? Y'all are really getting a clinic right now. And realize what he's teaching. I would say it's basic and intermediate information. Because if we get into the advanced stuff, you got to go over the Greeks right here, and I don't understand that. I don't even look at this when I'm buying an option because I don't understand it. Now, should I have looked it up by now? Yes, I should have. I'm the one that comes on here and pulls up definitions and stuff like that. But to me, it just never mattered as long as you understand exactly what he just taught. I didn't think I needed any of the Greeks and stuff like that. Look at how many people are interested in that trade at that price. Look at your strike price. Look at your break even price, um, and then look at the management of the company. Is the company being run into the ground? Is it being managed well? And do you think this company is going to continue to go up, or do you think it's going to continue to go down? I don't really do puts. I only mess with calls. So I'm the same as him. I got burned messing with puts in 23 on Tesla. But I got blessed too because I made a lot of money on the calls, but I got burned more than I got blessed. So I stopped messing with the puts. All right. It looks like no one has any more questions. Any more information you want to throw out there, or is that a wrap?
I think it's a wrap for now. Can't really think of anything else we missed.
You got any suggestions for any call that we may want?
Let me
What's that?
preface with this now. Hold it. He on this Discord. I gotta throw this disclaimer out here. We are making suggestions and educating. We are not responsible for any losses you may incur. You can give us credit with a shout out for some gains, but we are not responsible for any losses anybody might incur. You must do your own research. The our content is just intended straight up for educational purposes only. Now, with that being said, you could ask this question.
Good. I have, sorry, I got more to the question. So, for example, do you look at any kind of trading signals? For example, insiders have started pulling out. Most of the insiders have pulled out. There have been, for the insider in the Robinhood market, when you're looking at, back up, actually go in.
Weight shear, like I think Will said earlier, 20-30% is kind of average when it falls. If you want to try to get in at that point, and then if it drops a little bit more than that, it's a little more expensive than normal stocks. But dollar cost averaging options is a thing too.
Yeah, I think that's sound advice. All right, folks, I gotta let the forge go cold at this point. I gotta end this stream, but it has been he put on a clinic. I really appreciate you coming on, and yeah, we'll definitely have you again in about a month or so, or unless you guys need him to come back on for anything else, hit him up in the chat. He's there in the Discord all the time. We're posting stuff about news about companies and different ones to look at. He said he'll answer questions in the chat anytime. So the Forge is going cold at this point. Thank y'all for tuning in on a Saturday afternoon, and we will see you next time. Y'all have a good one.
See you.